The current UK tax year ends on April 5th, 2025, and this date could just about be the most important date in the year if you're a saver or investor. This is because various tax allowances will either expire or reset on this date, and if you don't make use of these in the current year, you could find your hard-earned returns from investments and savings being eroded in the next. Most of the tax allowances that we have cannot be carried over, so if you don't use them, then you lose them. And in addition to these allowances, there are also some lesser known, but very good tax efficient choices that you can make to reduce your tax burden. So in this video, I'm going to run through all things to consider as we get closer to that end date. And I'm confident that by the end of this video, just about every viewer will learn something that will legitimately help them to pay less tax. Firstly, we're going to look at probably the most obvious and well-known thing, which is the ISA allowance. This is the maximum amount of money, currently £20,000 a year, that you can put into a range of 4 different tax-free cash savings or investment accounts that comprise the ISA family. ISA accounts allow you to grow wealth tax-free, with no tax from interest earned on savings in cash ISAs, and no tax on capital gains or dividends from the stocks and shares versions. ISAs, with some exceptions, are flexible in that you can withdraw your money anytime tax-free. Rising interest rates, in addition to those stagnated or reducing tax allowances, mean that more investors are now paying tax on their cash savings or investments. But it doesn't have to be this way, with the protection that an ISA would provide against these taxes. So check your personal finances and consider using an ISA if you haven't done so already. Remember that you can't carry forward or roll back this allowance. What you don't use in this tax year will be lost forever, so it will be too late after 5th of April. One of the 4 categories in the ISA family comes with even better benefits. If you're aged between 18 to 39, you can deposit a maximum of £4,000 per year from your annual £20,000 ISA allowance into a lifetime ISA, which are also known as LISAs. These are specifically designed to help with a first house purchase or as a retirement pot at age 60, and you can get these as both cash or stocks and shares versions. Despite those withdrawal restrictions, these accounts are worth considering if age eligible because of the fantastic benefits they provide, with the government adding 20% on top of what you deposit up to that £4,000 deposit maximum. So you could get up to £1,000 extra per year from HMRC. This is possibly a better annual return than you'll ever get from investing in stocks and shares alone, so it should be a serious consideration if it suits your objectives. Another topic that is widely known but worth covering in any case is that if you don't pay into a pension, you could be missing out on a minimum 20% tax relief that HMRC will add to your contributions. If paying into a workplace pension, your pension contributions will normally get deducted prior to tax being applied to the remainder of your gross earnings, providing tax relief this way. If you have a separate private pension, HMRC will add 20% to anything that you deposit into your pension pot. An example of this is that if you pay £100 into a private pension, then HMRC will add another £25 to it if you are a basic rate taxpayer. And you could get up to 25% more tax relief on certain earnings by submitting a self-assessment tax form if an additional or higher rate taxpayer. The pension annual allowance is the maximum that you can contribute into a pension within a given tax year while still receiving tax relief on those contributions. Currently, this amount is the lesser of £60,000 or your annual wage, inclusive of the tax relief provided. And you do have more restrictions with a pension than you do with an ISA, as you have to reach age 55 to get access to it, and this age will be rising to 57 from April 2028. Saving into a pension is mostly a tax deferral strategy, as you're eventually taxed on pension withdrawals. In theory, this therefore makes ISAs and pensions generally equivalent from the perspective of tax. But the fact that you can also draw a special tax-free lump sum of 25% from your pension gives pensions an edge over ISAs in tax terms. You might also benefit if you have been a higher rate taxpayer and get an additional tax relief of 40 or 45% to grow your pension pot quicker, but then draw a retirement income as a basic rate taxpayer, only then paying 20% on the income up to the £50,270 higher tax threshold. A final good argument for pensions is that with the added 20% or more tax relief, you are far more likely to build wealth and reach objectives quicker than other ways. A consideration for you might be that you decide to hold both an ISA and a pension for that added flexibility. I recently published a video on the pros and cons of each, so check this out if you want to learn a bit more. And before we move on, if you are finding the content of this video useful and interesting, then please consider hitting the like button, subscribing to my channel, and to turn on notifications so that you'll be aware when I publish new content. Something not so well known, but very important, is that pensions can be a really valuable tax planning tool. This is because pension contributions effectively lower your taxable income. With rising wages, many more people are getting pulled into higher tax thresholds that have not been adjusted over the years. But you could avoid paying higher taxes if you can afford to pay more into your pension. Higher rate income tax kicks in once your income exceeds £50,270. So as an example, if your income is £60,270, you pay 40% tax on the £10,000 of income that falls within the higher rate tax band. By paying an additional £10,000 into your pension, you would automatically get that 20% tax relief as usual. But did you know that you can also claim back the other 20% on the £10,000 earnings through a self-assessment tax form, and therefore nullify that higher 40% rate? By doing this, you've just stopped yourself getting taxed at a higher rate. But you've also made a significant and important contribution towards your future retirement. It may be possible to carry forward any unused pension allowance from the last 3 years, so you might be able to claim back previous tax relief also. The same principle applies to helping parents retain more child benefit, again by effectively lowering your taxable income. Under current rules, you must pay back at least some child benefit when you or your partner's income exceeds £60,000 in a given tax year. Once income reaches £80,000, you pay the whole lot back. This is known as a high income child benefit charge. If, however, you make a contribution to a SIPP that reduces your taxable income to under £60,000, then you will avoid this charge. If you lower your taxable income to between £60,000 and £80,000, then this charge will be reduced. And doing so could help you utilise child benefit whilst putting money aside for the future. But it won't necessarily be right for everyone. Remember that this video is not to be construed as financial advice and is for educational purposes only. Fact check anything that anyone tells you on YouTube, including what I tell you on this channel. Your capital is at risk from investing, and you might end up getting back less than you invest. And please seek the advice of a suitably qualified professional if unsure of anything to do with your finances. Away from tax-efficient accounts such as ISAs and pensions, you also have some other personal tax allowances to consider before the end of the tax year. Under the Personal Savings Allowance for cash savers, basic rate taxpayers can earn £1,000 per year in savings interest without having to pay tax. Higher rate taxpayers can earn £500 per year before paying tax. And additional rate taxpayers don't get any personal savings allowance. Back when interest rates were low, these allowances seemed very generous, but rising interest rates have changed everything. And right now, there's an increasing chance that some of the interest on your savings will get taxed, so you might want to redo your sums. Fixing into a higher interest rate over 2 and 3 years won't help you to avoid the problem either, as you cannot carry over your personal interest allowance, and you will probably therefore pay more tax on a larger amount that's compounded over a longer period at the maturity date. Dividends are paid by companies to investors. As of the 6th of April 2024, the annual tax-free dividend allowance was reduced to £500. So anything paid in dividends over this amount is taxed if the special dividend tax rates displayed depend on your rate of income tax. Everyone has an annual capital gains tax allowance, or annual exempt amount. This amount was halved to £3,000 in April 2024 and is currently frozen at that level. Capital gains tax is levied on the profits that you make when you buy or sell most assets, including stocks and shares. To make the most of your annual capital gains allowance, you might want to consider offsetting gains with losses. If you have any capital losses from previous years, you can use them to offset your gains. This can help reduce your taxable amount, or timing your sales. If you have significant gains, consider spreading the sale of assets over multiple tax years to take advantage of the annual exempt amount each year. But if you want to avoid all this fuss and keep things stress-free, holding your cash or investments in a pension or ISA would protect you from tax. Another important thing to note is to not look at your salary in isolation, as you then might not fully appreciate your income tax position. Your rate of income tax depends on the sum of all your income from all sources. This includes salary, interest, capital gains, dividends, pensions, property letting, and so on. So don't fall into the trap of thinking that you're earning less than you actually are when determining your income tax band, and you might be doing this when deciding how much to put into a pension. Everyone, unless earning over £100,000, where it reduces by £1 for every £2 earned over this amount, starts with the same personal allowance regardless of age. This personal allowance is currently £12,570 in England, Wales and Northern Ireland, with higher tax thresholds potentially being reached as your total income increases. So to summarise what we've covered today, make use of your pension and ISA allowances as a tax-efficient way of building wealth for the future. If holding assets outside one of these accounts, make use of other allowances and release for income from capital gains, dividends, and savings to reduce your tax bill. Making additional pension contributions can reduce your marginal rate of income tax. But in doing this, tot up all of your income and don't just look at your salary when making your calculations of what to pay in. Parents can avoid having to pay back some or all of your child benefit you receive for each child through increased pension contributions. And putting your cash and investments in ISAs and pensions can help reduce your total income that will influence your marginal tax rate, as this will then remove dividends, capital gains and interest from the equation. Be mindful that your spouse can also hold certain assets to further reduce your taxable income on the highest rate of tax you pay. And as a married couple, you each have individual tax allowances to share your assets across. Finally, don't panic. There's plenty of time to act, but start now rather than turning the tax deadline into some calamitous event. And going forward into the next tax year, take steps this year to automate your finances to enable you to plan in advance for what you're trying to achieve. Thanks very much for watching.